Hey guys, my name is Dean Harris. I am the Vice President of CrestCore Realty. Welcome to the Investor's Guide to Memphis Real Estate. It's a podcast where we give our out-of-state investors the boots on the ground knowledge they need to be informed, savvy, and to win in the real estate game here in Memphis. As always, I'm joined by Douglas Skipworth. How are you?
Great.
Douglas is our founder and principal broker of CrestCore Realty and CrestCore Property Management, and you're also our largest client by far. So what you're saying, you eat the cooking?
Yes,
That's
I
great.
eat the cooking here.
You can listen to our podcast, guys, on Spotify, iTunes, our YouTube channel, Facebook page, wherever you want to catch that. And then if you have any questions, you can email me, dean@crestcore.com, about today's podcast or anything else. I also help clients buy and sell. I want to make sure that I get that out there. Sometimes this is just an information-based podcast, but I want to make sure that you know that we can help you sell, buy anything here in the city of Memphis, not just investment deals either. So we have a residential agent if you're local. So today's podcast, we're going to jump into interest rates, Douglas. It's a hot topic, and the interest rate is rising. So what do we do?
Yeah.
You know, what's the... You know, you and I base these podcasts on hot topics.
Yes.
And one of the questions we ask each other, like as we're planning the outline of this, is what are my clients calling about? What are they asking about? What are we discussing? What's the hot topic? In the last couple of weeks, it's been interest rates. So, I mean, let's just jump right into it. With them climbing, what's your kind of immediate reaction, like a non-planned, what's your reaction to hearing that the rates are going up?
I think the first thing is, the act now. It's a little bit of the kind of broken record of act now, buy now, sell now, refinance now, lock in long-term rates now, keep increasing your rents, act now. As I thought about that, what I don't want though, I want a sense of urgency. Right. Yeah. There's a sense of urgency, but not panic. So that's when you kind of step back and go, you're in control. We are all in control of our own actions and thoughts. So let's be in control of the situation. And that is, you step back and go, man, historically, this is still an unbelievable time. You hate to use the unprecedented time, but as you look back, like we have come through a time over the past 15 years where rates have been ridiculously low.
Almost
historically.
I mean, almost, some people even use the phrase free money. You know what I mean? Like, it's just so cheap.
Especially the past couple of years where the Feds had to lower the rate so long because of the for the pandemic. So yes. So even though we're kind of coming out of this free money stage, it's still okay. Yeah, you're still okay.
I think we're along. Like the people that have called me, my first few calls that I got, I was like, "What?
Yeah, really?
That's what you're concerned?" I'm not going to say, "Hey, that's irrelevant."
No,
but I'm not concerned in the slightest bit. It's not going to affect our pricing right now. It's not affecting the demand right now. It's not really affecting anything other than you're paying a tick higher on a note if you're buying now. Now, I guess moving on to our second thing is what's the effect, right? What's the effect? Like, how does that translate, and how does that move into affecting investors? And to me, all it's going to do for now is nothing. In 6 months or 12 months, if we still see a steady kind of climb, you are going to have that investor that looks at it and says, I either need to go ahead and lock something in now, or I need to get rid of what I have because I haven't managed it right, or I haven't financed it right, or something. If they feel like this is going up like that, I still don't think, Douglas, I still think we're 3 years. I don't know. I don't want to give a time. I still think we're a long way away from it affecting anybody dramatically.
Yes. I mean, it's so interesting, right? Because of what we keep coming back to some of the same things. Like, this is really Econ 101. This is like supply and demand, and the demand is so great and the supply is so constrained and so low that inflation has gotten out of hand. scorching inflation, 40-year historic high inflation.
Yep.
And because the demand, there was pent up demand, and then not only was there pent up demand from the pandemic, but there was also this supply issue globally because of the pandemic. So, I mean, you got this demand that's red hot and the supply that can't keep up. And so the prices are going up and wages are going up. And so in the United States, the Fed's going, hey, we've got to stop this inflation from getting out of control, slow down the demand. We got to kind of come in and the party's getting out of hand. Somebody's got to come in. It's getting late. Somebody's got to turn on the lights, you know,
call the cops.
Exactly. Kind of send some of the bad apples out, kind of to keep the party going. And what they don't want to do, they don't want to be the parent or the cops come into the party, turn on the lights, everybody out, because that they want the party. They don't want to kill the mood.
Let's just calm down.
Kill the vibe. Let's just calm down. Let's slow it down. So you'll hear the Fed talking about like a soft landing. They want to have a soft landing, a mild recession. They want to kind of tap the brakes, not screeching halt.
Because that would cause more chaos than what we have right now.
Correct. And they don't want to do that because we've been through some chaos. And there's still some uncertainty with global supply chain. There's still some uncertainty with pandemic a little bit. Like
I don't think that's going away anytime real soon.
Doesn't seem like China's got more issues than we do right now. And then, you know, Ukraine kind of global politics is out there. There's a lot of uncertainty. So again, all of these things are kind of factoring together that kind of say, you know, what is the immediate impact? I think the headlines sell clickbait, right? I mean, so I
think we're falling into some of that for sure. The clickbait of, hey, you know, read this story and sensationalizing everything, which there is in the spectrum, there is a chance that things could fall off the cliff. Oh yeah.
So that kind of headline is sensational and good and attractive. So, you know, just kind of like, hey, things aren't going to be bad or it's okay. Like what we're saying, it's probably not what you're hearing in the news.
So speaking of that, one reason I got into this line of real estate period was because I was in, you know, back in 2008, I was in that market, right? Crashed.
Yeah.
And I was going to work every day and selling nothing.
Right.
And I knew at some point I had to move into something that could be recession proof.
Yes, because you were selling new homes
new construction and regular real estate. Just like a regular
owner occupant.
Yeah. And I learned then that being a one-trick pony is not the way to go. So I'm building up to this interest rate hike, but I decided to sell these investment deals because when the market is good and the economy is good, like it is now, or like, you know, we have been for like, you know, 2 years, I guess, coming out of, you know, before COVID and coming out of, we've been selling the crap out of these homes. They've been, I mean, like to the tune of, you've heard it, 25 and 30 a month. I mean, 400 transactions a year. I mean, it's absurd. If the market were to take a deep dive again, or even a slow, steady decrease, we're still going to be selling these. You're just going to buy them differently, Douglas.
There are people who are praying that the market crashes.
There are
buyers
okay
out there who would love nothing more than the opportunity of a lifetime, again, to come in and scoop up houses for discount prices, because they now know what the long-term future holds for single-family rentals specifically. That's right. That's not going to happen right now.
I don't know that it ever will.
You can't say never, but the likelihood of that happening is so remote because there's so much money that is ready to be put to work. So I don't think that you're going to see any type of radical drop in price, no matter what happens, because there are too many buyers who would swoop in that scenario and prop the prices right back up.
And we'd go right back to where we were 10 years ago or whatever, with our rents staying about the same and our price points going a little lower. You just are buying it differently. Yeah. And I'm not prepared. I'm not, by the way, like, you know, and I know I'm not waiting on that. None of my clients are waiting on that. No. You can't, because in all likelihood, I mean, I'm talking 90% or higher. That's not coming. We're not hitting a 2008-9 depth again from a low point in the market. We're just not going to go down that low. The government won't let it happen again. I mean,
no, it's not. I mean, it's just not there. credit has been tighter, so
Yeah.
there's not a lot to foreclose on. There's not a lot of troubled loans, and the foreclosures have, I mean, gone like interest rates from really high to really low, and there's not a lot in the pipeline.
Qualifications are so much different.
Still so rigorous.
Douglas, we'll move on, but I'll tell you this. We were loaning. I was sitting in sales meetings in new construction. I remember the lenders coming in saying, hey, we just got a reduction in the credit score to 525.
Right.
So if your client has a 525 or up, we can get them approved. Stated income,
yeah, no
100%
income, no job.
financing. All you had to do was float the $500 earnest money, and you could get that back at closing. No one's doing that. So we won't find ourselves in that situation again. Let me ask you this. In that investor pool of people that are out there with these rising rates, who do you think's going to be affected first, or the worst, or the most, I should say? Like what pocket? Because I've had people say like, hey, what do you think that does to my portfolio? What do you think that does to my 10 or my 3 or my whatever? Yeah. And I'm just curious your opinion of like who's affected.
I mean, the first things I think of like variable rate. Like if you're on a variable rate, anything, that's going to go up, right? The Fed, like we are talking right now. The Fed is meeting today and going to raise rates 0.5%. 50 basis points. So it's going to go up, and that's the Fed funds rate, but that affects the 10-year treasury, which affects the mortgage rate. So all of a sudden, and they don't go exactly lock in step, but they have the same, they echo each other. So rates are going up on mortgages. And so, if you have a variable rate, it's going to increase this week. If you're borrowing from a bank, it's going up 0.5% today. So because prime rate, because I base it off that. Anyway, so I think that. Also, as you're burring, properties, you and I know to buy, just for burr, everybody should know, buy, rehab, rent. And then refinance. Well, but between the buy and rehab, renting, before you get to refinance, what happens if rates go up 0.5%? Or if it takes you 6 months, they might go up a full percent. So your projections might, as what you were planning to borrow at, maybe you planned to borrow at 5, now it's 6.
Yep.
Maybe you were going to amortize it on 15 years and you need to amortize it on 20, maybe 30 to keep your payment in line. So there's some things you can do, but it changes the game a little bit. So I would say anybody who hasn't locked in a rate, that's
kind of what I was going to say. The guy that's got 3 or 4, I'll use the example. Let's say the guy's got 4. 2 of them are vacant now. They each need $15,000 a piece to get them rent ready. So he needs $30,000. He's got mortgages on all 4. The rate comes up. His 2 tenants are barely paying the note for all 4, right?
Yep.
Barely. He might even be contributing some with insurance or whatever. So what do? I'm just going to leave these 2 vacant. I don't have the $30,000, or I don't want to spend it, or here, let's put 5 in here. See where the trap falls? Mm-hmm. Well, let's just put 5 in here and put somebody in there. Then the maintenance comes and kills you. All the time when your rates are going up, you got to manage this properly. This is no scare tactic. I don't think this is, matter of fact, this might be something in 6 months that you and I look at each other and go, golly, that was a pointless podcast, right? Like it hasn't changed, but it very well might not.
No, I mean, Fed definitely is raising rates, but I hear what you're saying.
You know what I mean? Like we might just be sitting here going, hey, we're still buying and still moving. I think that's exactly what's going to happen. I don't think this rate hike is going to frighten anybody to death.
No.
It's not going to take prices and dip them. I mean, It's going to take a minute. I don't believe waiting on the sidelines is the right move either, because Douglas, like I had guys in the pandemic say, ooh, I'm going to hang tight. Man, these prices are going to go way down.
They're still waiting.
Like what? Like you're still sitting there staring at me going, hey, when are they coming? Like they're not.
Everybody who's bought a house in the past 2 years during the pandemic, that house has appreciated. Now, will that last forever? No. But anybody who was waiting missed out on house appreciation.
Yes.
They're lost. It's okay. But as far as opportunity in the future, I mean, you can look at the historic of what's going to happen and things. We've talked about this a dozen times on the podcast of where we're going to be in 10 years. there's going to be the days where things are going to fluctuate like a stock market. But if you look over long term, this Memphis and this opportunity is going to be big. Rates are going to be high sometimes. They're going to be low sometimes. But single family is a great opportunity to act now and to buy, sell, refinance, whatever you need to do today.
And my next thing was pricing will be affected, but I don't think it's going to be affected much. I really don't. It's going to take and I'd love to know the math. I'm just not this smart, but I'd love to know, like, hey, what interest rate hike or point will be the tipping scale for our prices to go down? Because your buying power as a buyer, your buying power goes down, right? If you're borrowing with a rate hike. So what that means is that the pricing, if it's a big wave, the pricing is going to have to come down a little bit in order for people to sell. I don't even. And I'm just sitting here, just shooting back and forth. But I do feel like, at some point it'll affect it. But I don't know that we're anywhere. Do you feel we're anywhere near that?
No, and and listeners know from the time it's like I am not made to talk without facts. Like I can't. I have to, I can't BS. So I got to go get the research to show, hey, here's what historic rates have done. So we're in a good spot. Here's where everything is. Wages have increased over the past 30 years, 20 years, have more than doubled the hourly rate. So
more than doubled.
It's more than double. People are making more money now. Now it might not be worth as much with inflation, but they're making more money, which is why rents have gone up. To your point, but one of the slides that we got from a title company, Fidelity, they underwrite all of they're one of the big title insurance companies. So they're closing stuff all over the country. So you ask I don't know if you asked this question specifically, but the biggest impact that's going to have right now is on mortgage originators, loan officers, on refinances. Like people are not refinancing right now. If they don't have to. Because they did that over the past 2 years because the rates were cheap. 2%. People locked in 2%.
And said, I'm going to stay here.
Let's stay here for 15, 20, 30 years. That's great. So that's the biggest impact, right, of this is that mortgage refinances. So on anything, you're just not refinancing now. However, you back it up. It was 3 years ago, exactly, I locked in on a long-term investment property loan on a major refinance at 5.12.
Still a great rate.
Still a great rate. And guess what happened after we locked in?
It went down again.
Yeah. And maybe I could have locked in at 3, but
you're there now.
But I'm at 5%.
It's still great.
It's still great.
I bought my first house in 2003 and it was 7.75, I think, 7.5.
Exactly. And so rates are going to come up and what they're trying to do, as we talked about, is to squelch or dampen demand.
Yes.
Half a point isn't going to do that.
No.
A full point, and that's their whole point. There's like they don't want to just dump water on the fire. They want the fire to kind of want it, not put any more logs on the fire and kind of control it, move it around. A control burn, right? So that's what they're trying to do. So they'll raise it, and it's not like supply is just going to pop up to meet demand. I mean, that's one of my questions. There's still materials and the global supply chain is shifting, as we know, from this globalization where we're all dependent on each other to more like, hey, maybe I'm going to start being a little more dependent on myself, which is cool. Again, that's maybe a pendulum that's swinging, but that takes time. I mean, you can't ramp up and replicate what has taken, in 30, 40 years to build out to then turn around and go, oh, now we're going to do all of our own supply chain. So to your point, I just don't see anything changing the market rapidly so long as the Fed does what they say they're going to do, which is systematically raise rates over time. It's, another point this year, another point next year, for the soft landing, to kind of the controlled burn, to keep everything okay.
So if you guys are looking for a doomsday interest rate situation, if that were to come, it's going to come slow and it's going to take forever, years. In my opinion.
Again, this is what's the most likely case. Obviously, pandemics happen, wars happen.
Yeah.
Outside of the ordinary. Now, those are black swan events, and so you plan for black swan events, right? Yeah. Like, you don't know exactly what's going to happen, but you know something bad's going to happen. So you plan for the unexpected. But that's why you don't over leverage. That's why you don't mismanage. That's why you keep your reserves. You got to be prudent while you listen to stuff like this, while we talk about it and plan. Kind of like the plan, it's not necessarily the plan, it's the planning that's really good.
That's right.
And that's what we're doing here. You're just planning for the future.
So let's talk this, like, you're thinking years down the road. You think inventory catches up with this?
So great point. That is exactly, oh man, Thank you.
Because if the buy,
you tee that up. So that fidelity, man, they had an awesome slide. I want to tell you what they said. They said that the lack of inventory is right now. This is from April 22.
Okay.
So the month supply of inventory is 1.7 months of inventory.
Is that an all-time low?
It is as low as it is. So it is as low as it goes that we've seen. Because in April 2021, a year ago, it was 2.3 months. And they said that 6 months of supply is considered healthy and associated with moderate price appreciation. So anything below 6 months, what I take from that and what we've seen is anything below 6 months worth of inventory, it's without something to really crush demand, drives up prices. Crazy prices.
Frenzy.
20% appreciation. So until we get inventory back in kind of a equilibrium-ish kind of state, you're still going to see appreciation unless you can do something to drive that demand down.
Which is maybe what that rate's trying to do.
But then again, they don't want to do it to go from, what they don't want to do is to go from 1.7 months of inventory to 6 months of inventory
just
next
like
month.
No.
So they're going to be like, maybe we'll raise it to 2.5, maybe to 4, so 18 months from now, we're back to equilibrium.
That's
what they're trying to do.
Fantastic data. That ought to tell you what you need to know right there. That's enough right there to know that we are still in a red hot market. Still the demand. I mean, like you're telling us right now that there's only a month, 1.1,
1.7,
so
not even
under
2 months worth of supply. And you know that. You see it.
My gosh.
How much your borrowers, your buyers want houses. How hard is it to find good deals? You have to look. You have to work.
More difficult than it's ever been.
More difficult than it's ever been.
Yeah. And shameless plug here. Well, we closed 30.
You were working as hard as you ever had to find opportunities for people.
Yes. And I will tell you, part of what our success has been how long I've been in it and in the trenches with this. Yep. People know my name in this thing, so they try to come and get rid of whatever they have. So that is an advantage we've got. This might be something, Alec, that we can share that fidelity information and maybe some of these graphs, because I tell you, that is powerful.
It is.
That's factual. There's not anything you can even argue about. You can go from a year, you can see where the supply is going down.
It has gone.
And our demand is continuing to go up. Now this interest rate over time can maybe. So the answer to my question is, do you think it affects inventory down the road?
Yes. Yeah, it definitely will. Inventory will eventually increase.
The big key in there is down the road.
Yeah,
right?
when.
Like, what does down the road mean? Well, it means down the road. There is no. If I knew where it was or we knew where it was, we'd tell you, hey, it means next January. But down the road means we don't know, but we see it. I do think it will. I think if that's the answer to a lot. People say, well, if the hedge funds quit buying, no one's quit buying, folks.
They're not going to quit buying.
I got news for you.
No. They're not quitting buying.
None of these big monster institutions are going to stop buying. It didn't happen. So you need to learn to
that
adjust.
is
So
not
if you're the
happening.
agent out there, man, I could get on a soapbox with this so fast. If you're an agent or a mortgage lender out there and you're crying and you're griping about hedge fund buyers buying houses, you best get used to it. It isn't going anywhere. It's going to be here. And whether I like it or not is an opinion I can share off of this, but it isn't going anywhere.
It's not going anywhere. So
right.
It's just
so deal with it.
Right.
Adjust and deal with it.
Shift.
So this shift, this mortgage rate, the interest rate increase, I agree with you, is going to help our inventory down the road.
Down the road, yes.
It's not going to do anything
again,
for us now.
and again, I don't want to sound like the guy crying wolf, but that down the road, you don't know what it is. That's why I'm saying act now. If you want to buy something, buy it now. If you want to sell something, sell it now. If you need to refinance it now. I mean, I got that condo. You remember a couple of weeks ago we were here talking about a condo?
Yes.
Under contract.
It took 3 days.
Yeah. Under contract.
Took 3 days because people need it.
And guess what? That list price was almost 3 times the carrying value of that, adjusted basis of that property.
Because someone saw the value in it and they can come and make sense of it.
Awesome.
It's so awesome.
Such a great market to sell,
but
buy. A great opportunity to buy right now before things get down the road.
I want to make sure too I say this because I'm always real clear with my clients that if you hear us say that and they hear us say that and they think, wow, these guys are just trying to sell houses here, do yourself, prove me wrong and wait and find out.
Yeah.
You know what I'm saying? Like I believe 100% of what you're saying and what we have been saying for about 9 months is you need to buy and sell now.
Yes.
If you're looking to buy, I believe it's going to get more expensive. If you're looking to sell, I believe those rates are going to flatline the prices at some point and maybe even go down a little bit. I mean, that's why I really am encouraging people. This isn't a matter of me getting more transactions in a month. It really isn't. We sell houses, right? If you're looking to maximize profitability or the best price or whatever that you can get, you just heard this example you just get of a year ago. We're way lower than inventory than we were even 1 year ago. Mm-hmm. So what's it going to look like next year? Who knows? But I am here to tell you that it'll be different. And if you are looking to buy now. I bought 2 last month. I'm buying.
Yeah.
You're selling.
Yeah, I bought that one in a month ago. 30 days ago.
Here. That's
not
right.
Even 30 days ago.
That's what I mean. You're buying, you're selling.
Absolutely.
I'm buying. I'm not in the selling mode. I just don't have quite the portfolio to sell, but I'm buying and going. And I don't, when the rates were high, how long, this is something to consider. It's like real estate investing didn't just really get red hot in 2015. You know what I mean? Like people own rental houses for forever. For as long as I can think about it.
Oh man.
They've had rental properties and in real estate investing. So this isn't going anywhere. That you just have to learn how to buy right. The phrase buy right is so relevant now versus any other time. If it fits into your payoff, your cash flow, buy it.
Right. And that's so and that also buy right for you. Right.
That's right.
Because for your goals and your objectives and your vision for where you want to be might be different. This looks a lot different for somebody who wants to pay cash, for somebody who wants to finance it and pay it off in 10 years, for somebody who wants to pay it off in 30 years.
I don't know how you buy, but I do not sit there and go, $100,000 for this house. Is that house really worth $100,000? Is it worth $100,000? I'll look and see some comps and find out if we're somewhere in there. But does it cash flow? Can I pay it off in 15 years? Can I, or 10 or 20 or whatever my goal is?
Whatever your goal.
My goals are different. I have shorter
so
pay
what
down
it's the what's good for you, what's good for the goose, good for the gander, in the sense of like, hey, this could be one man's trash and another man's treasure, maybe another way. That sounds derogatory, I guess, but it's like what might work for me might not work for you.
Oh, I have a close friend
on the same property.
I have on the same property. I have a close friend who we buy about the same thing, and he's got 55 or 60 of them or whatever. Yeah. Like I wouldn't do it like he's doing it. Right? He has a completely different strategy. He wants to live on the cash flow now.
Okay.
All right. So he's trying to buy as many as he can for only one reason. He's not really concerned with pay down. Right? Yeah. He might one day, he's trying to get that cash flow up so he can live off that cash flow. I want to pay down.
Right.
Right. Of my income and my regular job takes care of my families. I'm trying to pay down.
And there are other people who want neither of what y'all do. I mean, you want to pay down quicker, or let me rephrase that. They want the pay down just over a longer period than you.
Yes.
They've got a longer time horizon than you do.
That's exactly
so they
right.
can extend out their mortgage longer than you can, which means they can pay a higher price than you can.
That's right. Which is
on the same property.
On the same property.
Does that mean you're not buying right or they're not buying right? They're buying right for themselves. So all that to say is like, you need to buy right, but you need to buy right for yourself.
That's right.
And what yourself and what your goals and your objectives are to make sure that you're doing what you need to do.
Remember this too. If your numbers are snug right now, the rent's going to go up. Even if we took a 3%, just an average rise in rent every year, in 10 years from now, is your $1,500 rental that's a $2,000 rental? Is it a good deal? You got a fixed cost on the house. I did this. I said this in another podcast, and it has stuck with me. That kid, that broker from New York,
right?
You know, he's like, "Hey, yeah, I'm buying a house for $250,000 that only rents for $1,800." I'm like, "Whew, that's tough. How do you make that work?" Well, Dean, in 10 years, is your
rent's going
to go up 30%? More than likely.
Yes.
He's like, now you got a $400 rent. Now is it good? I'm like, yeah, now it is. Yeah. Right. You just got to, different people have different strategies. Yeah. That's a different strategy. They're all different strategies. So make sure you buy right for you.
Buy right for you.
Know that we're going to see some changes at some point down the road. I'm sticking with down the road. We ought to make part of the
I love that. Down the road. That's great.
Because it's so,
that's true.
Everyone can define that differently. But yes, I do think we're going to see some changes down the road. I do not feel we're going to see anything, even this calendar year, that's going to really shake somebody's trees. You know what I mean? I just don't think that
outside of catastrophe, outside of the asterisk, that the 9/11, the pandemic, the World War III.
Yeah. Which
that's always possible, but the likelihood of that is remote. Now you just got to plan for something bad to happen, so you don't over leverage. You don't buy. You buy right. You don't throw your goals, objectives, parameters, your disciplines out the window.
I had a question.
You have to be disciplined.
I had someone ask me that yesterday. She goes, Dean, what'd she say? Because I want to make sure you get her. Hey, Dean, I ran the numbers here. What do you think? I get that a lot, by the way.
Yeah.
I'm like, well, what I always do too, I just make sure that I don't ever look at the percentages of I just look at what they're accounting for. You know what I mean?
Yeah,
like, you budget for this, and this.
Good call.
Looks like you budgeted for everything. Well, do you like how much? I'm like, that isn't going to be me.
Right.
What do you want this to look like?
Yep.
Right? Do you want to earn this? Do you want to earn this? Do you want to pay down here? They're like, why can't you figure out a cap rate? Because for one, cap rate's a multifamily thing anyway. There's too many factors. That's what a cap rate is. Coming back to a single family house, it's like, what do you want your return to be? Your cash on cash. You tell me. Then we can determine, hey, is this a good deal or not? Buy right for you.
Buy right for you. Set your guidelines and don't make exceptions.
Yes.
That's what I would say. That's what I'm saying. Don't make exceptions. And if you make an exception, you better know why you're making that exception, and you better have a contingency or an understanding of what is mitigating or protecting that.
That's what I told her too. I just said, hey, does this work for you? She goes, well, this works in my numbers. I just want to think.
Well, congratulations.
That's exactly what I said.
Yeah.
I was in, sweet. You found one that works your numbers. Like, let's offer up and let's get this thing. What'd she do? We offered up and got it. So
love it.
Love it.
That's great.
It's a great story because that is exactly what that new investor is feeling. They're like, should I enter into this? Yes. It's only going to get better. The rates are going to go up. The things are just going to get better. You're going to have more opportunities. Are you going to look up? I said this about hard money too, Douglas. You know what I'm about to say. I say this about hard money every single time. I don't care if you took a hard money loan out for 10 years and you paid 12% the entire time and somebody got, over on you. Did you pay the house off? Is it done? Do you own it outright? Is it, are you collecting rent? Who cares? I will never go back and say,
you won.
Dang.
Congratulations.
Yeah. But I can't believe I paid 12%.
Did you win by 1 point or did you win by 25 points?
No one ever knows.
Doesn't matter.
No one ever knows.
Doesn't matter.
No. No one ever knows. And that should be stuck with you right now. If you're at home and you're like, man, I want to be that investor, but I got to wait on these rates. You're going to always wait. You're going to always sit there. You're going to always be on the sidelines and wait. You know, we do, you and I love the sports analogies. You and I do this all day long, but it's like, you know, the player on the bench, like, you know, you're never going to feel like, whew, I'm ready to come into this game. I never play, but I'm ready now. Just go on out there. You've practiced all week long. Your muscle memory will take over if you've prepared right.
Yeah.
So when you're into this in real estate investing, prepare right.
Yep.
Know what you're looking for, know what you want, and then just jump in and execute it. What? So what? It goes wrong? We'll sell it. You don't get the best numbers you want? Adjust, whatever. Just don't sit there and tell me like, hey, I want to sit here and watch these interest rates. I don't. If you're thinking about calling me today and saying, hey, I'm going to wait for a little while and watch interest rates, just save it. Just don't. Because I don't care. I mean, like, it makes zero sense to sit around and say, hey, I'm not going to jump into this because the rate's up. For one, like you've said 10 times in this podcast, they're historically low still. They're going to remain historically low.
Even as they go up.
Even as they go up. They're historically low.
Yeah.
If you're panicking, don't. If you're going to sit on the sidelines, don't.
No.
If it's for rates, don't.
Yeah, not for rates.
Enter into this, find out what's going on. And I, you know, if you continue to buy right, I think you're going to be safe.
Yeah. I
In a
love
nutshell,
that. You know,
I mean, like, buy it right. Like,
have a sense of urgency, but don't panic.
Yeah.
Act now.
You take anything out of this, take that out.
Yes.
Sense of urgency, don't panic, and buy the house right, and you'll be fine. You'll be fine at an 8%.
Buy the house right for you. That was gold, and down the road things will change.
That's right. Appreciate you.
That's awesome.
Great show today. If you guys have any questions, please let me know. Dean@CrestCore.com. You can go to Spotify, our YouTube channel. Just search Investor's Guide to Memphis Real Estate on Facebook, YouTube, Spotify, iTunes, wherever you're at. You can check it there. Anything else? You good?
That's awesome.
Okay, guys. See you next time. Appreciate it.